Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what you see in front of you is my portfolio, and this is what I like to call a dividend growth portfolio. It's getting there, and you will get there inshallah, because that's my goal. And dividend growth portfolios are normally basically consists of companies that have a long history of dividend growth. So we're talking about dividend aristocrats, dividend kings, challenges, whatever you want to call them. We're talking about strong financial position, companies that have a healthy balance sheet and consistent profitability to support future dividend growth. Because that's important, okay? If the company has a healthy balance sheet, that means if they have excellent free cash flow, and after, of course, the revenue is actually growing, which then some of them, that money translates into free cash flow, which then that means they can actually use that money to buy back their own shares, which is good for investors, because that one share that you own now all of a sudden is actually worth more. And also, if they're paying any debt that the company has, they are acquiring other businesses, they're paying off debt, so and paying you a dividends. So they actually giving value back to the shareholders. That's the type of companies I'm looking for. Exceptional track record of basically increasing that dividend. And of course, they have a strong competitive advantage and so on. And they've got sustainable growth when it comes to their business side of things. So what I'd like to do today is share with you guys 8 different companies that have increased their dividends recently. And these companies are not just increasing because they want to, okay, but because they are actually in profitable businesses. So I'm going to share that with you guys. Some of the companies I do own them in this portfolio, some of them I don't. But before we do that, I'm just going to talk about a couple of things. But the first thing I'm going to ask you as always, is if you can join us in the Patreon account. Genuinely makes a huge difference. It helps us, of course, pay off for all the software that we use for us to find all the research for you guys. So join us on the Discord, inshallah, and you get access to a lot of these little things, inshallah. But first thing I want to talk about is the S&P 500 and just general markets. As you can see today, things are okay. We're not doing well, but the Nasdaq is actually doing okay. The last 5 days, because of the elections and everything else, as you can see, things been absolutely great. But FTSE again, disappointing. Okay, nothing really happening with that one. For the 1 month, again, FTSE is down 1.2. The UK stock market is not doing well at all. It hasn't done well at all for a long time. But look at this as well. The last 6 months have basically kind of been going backwards, which is really disappointing. But year to date is slightly better. It's about 5%. Where would you invest all your money in that 5% or the 25% in the S&P 500, which is, look at that, 27% in the Nasdaq. It's really disappointing. I do own a couple of companies in my portfolio that are UK based, but they're the top ones, so I'm not really affected by much. And some of them is because, like Rio Tinto, I'm there for the dividends, and it's a UK based company, very cyclical business. It will go up 20% in a couple of months and come back down 25% next month. Anyway, so that's what I wanted to share with you, the first part. And the second part is just the fear and greed part is still back. Still right now we're in greed. Recently we're in neutral. We're at 1 point here, at 1 point there. So it's going to fluctuate. And as always, it's not going to make any huge difference to our lives. The most important thing for us is long-term investors is to do that long-term investing and don't worry about the fluctuation, the prices in the stock market. So what I'm going to do now is go through the 8 companies. Some of the information I'm going to skip, of course, because otherwise it will be here forever. But yeah, the most important one that we're looking at is the latest increase. Now, a lot of the dividend information that we're going to see today comes from Seeking Alpha. I started using Seeking Alpha a lot more because that's the way I have my subscription and so on. And of course, everything here comes from different websites that I use. I put it together. It takes a lot of time and effort to put these things together. So generally, I appreciate if you can press that like button as always. Like I've always said to you guys, I will do everything I can, inshallah, because things are busy right now, but inshallah, I will continue posting as much as I can. Now, first one we're looking at is Rockwell Automation. 33.4 billion market cap. It has a wide economic mode, $277 per share. As you can see here, dividend is actually quite decent, 1.8% of dividend yield, which is nice. The payout ratio only 45%. It's important that companies do have a lower payout ratio, because that means the amount, basically what percentage of the net income is actually basically given out as a dividend. So 45% is not bad at all. So they have room to grow that Okay, latest increase was only 5%. The 5-year growth rate is 5%. 14 years of increase in it. Annually, you get $5.24. Now, dividend safety is basically A. So A plus is the highest you can get. So A is decent. So that's probably equivalent of, I don't know, 90% or whatever, or if it's slightly higher. The 5-year growth rate when it comes to compound annual growth rate for the revenue right now is 6%. And when it comes to EPS, it's minus 2% in the last 5 years. Profit margin, we're looking at a list of 12%, and return on equity 26%, return on invested capital of 20%. Free cash flow right now $1 billion. It's a small company, so $33 billion, $1 billion of free cash flow, not bad at all. 3% when it comes to that free cash flow yield. And then total return the last 10 years, 12%. Growth estimate for the next year when it comes to revenue side of things, we're looking at about 4%. And EPS, we're looking at about 11%. Morningstar is saying valuation right now is about fairly valued. $270 per share is where they think the price should be. The next one is A.O. Smith. This is one of the companies I looked at about 2 years ago. I was very close to invest in it. At the time, I think it was about $60, if not lower. It's gone up a lot since. 11.1 billion market cap. Narrow economic mode, $76 per share right now. Again, 1.8 billion. Percent dividend yield, 33% payout ratio, which is nice. They increased it by 6%. The 5-year growth rate is 8%, which is also really good. 31 years of increase in that. So they are a dividend aristocrat. Annually, you'll get $1.36. B plus when it comes to dividend safety. The 5 years 5% when it comes to revenue. EPS is 9%. Profit margin, return on equity, return on invested capital is really good. Free cash flow of 483 million. Remember, it's only one, basically closer to $10 billion, so that's not bad at all. Free cash flow yield of 4%. Total return the last 10 years 12%. Growth estimate next year is 3%, 8% for revenue, by the way, that is. And then EPS is 8%, 13% premium right now, $67 per share. The next one is AbbVie. Again, if you like any of these companies, by the way, just to go on any other websites, dig deeper, okay, understand a bit more. So for example, if you wanted to find out a bit more information about say for example Rockwell automation, sorry, what I will do straight away is go to, for example, Seeking Alpha website. You can see what the basic analysts are saying about the company. You can go to the financials, which is the most important part. Once you're in here, you've got the income statement. You can go to the revenue side of things. So check the revenue. So from $6 billion to $8.2 billion, 3%, $3.1 billion of that becomes gross profit. Then their net income, okay, so you can check the net income if it's growing, if it's declining, what has happened. So you can see in 2021 they had $1.3 billion, then it has declined, then it bounced back. So it's very cyclical business. So you can do a lot more to find out about these companies. You can look at the basically the basic EPS as well, from $6 to right now about $8. So there's a lot you can find out about these companies. Then of course read their 10K, understand their business model, understand their competition, and so on. So there's a lot more to do other than just what you see in front of you right now. So AbbVie again is one of the biggest pharma companies, 356 billion market cap, wide economic mode. Currently the dividend yield is 3.3%. The payout ratio 58%, which is not bad at all. Latest increase was 6%. The 5-year growth rate 8%. Now according to Seeking Alpha, it's saying it's 11 years. Now this company has basically split from AbbVie Laboratories. And because of that, they actually inherit the kings, basically dividend kings as status from them. So I think they've gone over 50 years, but this company has been around for 11 years. So that's why probably this is why this 11 years is here. Annually, you get $6.58. B minus right now. The 5-year growth rate when it comes to the revenue is 11%. The EPS 9%. Profit margin and return on equity, return on invested capital, no issues. $17.7 billion of free cash flow. Free cash flow yield of 5%. Total return the last 10 years, we're looking at about 15%. Growth estimate for the revenue next year is 5%. 11% when it comes to revenue. Fairly value right now, $178 per share. Right now, it's just over $200 per share. The next company is one of my favorite company all time, and the only one that I own so far on this list so far is Visa. Visa is probably one of the best companies when it comes to dividend growth side of things. But of course, the dividend yield is non-existent almost right now. It's just less than 1%. But again, the payout ratio is very low. They are increasing every single year. They've done that for the last 15 years. The last 5 years, 16%, which is the highest that we've seen so far. In terms of dividend safety, you got a basically right now, and the revenue is doing really well. Profitability is amazing. They got excellent free cash flow. The last 10 years, they've actually basically, given shareholders 18% every single year in terms of total return, and they expect it to grow really well, but 13% premium right now. Remember, it wasn't not long ago this company was actually fairly valued or undervalued. Right now it's about 13% premium, $272 per share. That's what they expected. Right now is over $300 per share. Next one is another one that I own, one is new to the portfolio. Canadian National Resources, they've actually increased that dividend about 7%. The payout ratio is quite low as well, but the dividend yield is closer to 5%, which is quite nice. The 5-year growth rate, we're looking about 23%. Basically 8 years of increase in it. $1.63 is what you get. B minus 12 years of basically when it comes 12% when it comes to the revenue side of things. EPS 20%. Everything else, profit margin, return on equity, return on invested capital, really good. Almost $7 billion of free cash flow right now. The free cash flow yield of 10%, total return 9%. Growth estimate for the revenue next year 4%, which is very decent for this company. EPS, we're looking about right now about 13%, which is really nice. A lot of the oil companies have a negative growth when it comes to the next few years when it comes to revenue and EPS, but this company is absolutely fine. And 13% upside from where we are. Seeking Alpha, this information comes from Seeking Alpha because Morningstar does not actually have anything on their website directly, but if you use Interactive Brokers, I've noticed that you can actually get some sort of evaluation for this company. But yeah, I'm going to use the Seeking Alpha one for now. There we go. The next one is Aurora Technologies. We're almost there. Okay, another company that I've talked about quite a lot, software side of things. Wide moat, price right now 571, dividend yield just 0.5%, payout ratio 17%, and latest was 10%, which is absolutely amazing. 10% growth for the last 10 years, 27 years of increasing. So another dividend aristocrat. Payout ratio, annually, the annual payout is about $3. When it comes to dividend safety. The revenue side of things, EPS is absolutely fine. Again, same things for the rest of the profit margin, return equity, return investor capital. Again, free cash flow is fine. Total return the last 10 years, 14%. Again, the expected double-digit growth for revenue and EPS for the next year, 2025. And right now, it's about 15% premium, $490 per share is where they think the company should be. The next one is the one I own and kind of newish to my portfolio. So EOG Resources, I think they've just reported a couple of days ago. They've increased a couple of days ago. And as you can see here right now is over 4% when it comes to that dividend yield, 28% when it comes to the payout ratio, which is quite low. Latest increase was 7%. The last 5 years about 29%, but they have only increased it for the last 7 years. So we'll see how that goes. Annually, you get $5.14. A minus when it comes to that. Revenue, EPS, fine. Profit margin, return on equity, return on invested capital, wonderful. 5% of $5 billion free cash flow, 7% of free cash flow yield right now. Total return the last 10 years 4%. Growth estimate next year is 1%, and EPS they're expecting it to decline about 2%. Now anything can happen if oil prices pick up again because of whatever his name is, Donald Trump. He's saying he's going to dig more oil, which could potentially hurt these companies, by the way, because if you think about it, if he digs more, then there's more supply and there's less demand. Therefore, the price of oil will come back down. The profit for these companies will not be as much. So I don't know what the noise is about, but we'll see what happens. But fairly valued right now, $124 per share is basically where they think it should be. Right now it's about $130 per share. And finally, the other company is also I own this one as well. Automatic data processing, wonderful business. Right now it's dividend yields 1.8%. The last basically 5 years they increased about 12%, but right now it's 10%, which is absolutely amazing. Now this is slightly higher, okay, 59%, but it's not extremely high. Anything about 60%, I'm a bit I have a question mark next to it. Right now UPS are probably closer to 100%, which is crazy. But this company has increased its dividend for 50 years. But if you look at Seeking Alpha, I think they've said it like 25 years or whatever. but I know this company is a dividend king. It just became dividend king. When it comes to the what you get annually, you get $6.16, A minus in terms of the 5-year growth rate, the revenue side of things, EPS side of things, profit margin, return on equity, return on invested capital, the free cash flows. Everything this basically about this company looks absolutely amazing. They're expecting the earnings to grow next year about 6%, 9% after that. Fairly valued, $280 per share is where they basically think the price should be. Now, just to quickly show you from Sharia compliant side of things, you can post the video according to Zoe Sharia compliant. The standards that they use, all of these companies are currently Sharia compliant. That can change anytime, so you have to be mindful of that, but that's where we are now. You can pause the video, you can have a look at these individual stocks. But as always, if you like this type of content, like I've always said to you guys, it takes a lot of time and effort to put these videos together. I would genuinely appreciate if you can just join us to the Patreon account, where you get a lot of basically things out of, inshallah. Have a wonderful day. Assalamu Alaikum.